Hi everyone, Steven Jackson back here with Integrated Wealth Management, going over the third and final bucket of our income strategy in retirement. Over the past couple of weeks, we've reviewed these first two buckets, the safety bucket and the income bucket. Now, the safety bucket, just a reminder, is going to be that ultra short-term need that is going to be more on the emergency savings side. It's already taxed, it's accessible, and you don't need to make a phone call to get it. Second, we have that income bucket. Now remember, the most important attribute here is going to be that this bucket does not experience any type of volatility, so that you know that you're able to continue doing the things in retirement that you want to do without worrying about market fluctuations. All right. And now finally, today what we're going to be going over is that growth bucket. This is my personal favorite bucket. It is just kind of where I spend a lot of my time on the investments portion of things. And what the cool thing about this three bucket approach is oftentimes growth and retirement don't go hand in hand in our minds, right? You've retired or getting close to retirement, and now you're thinking, okay, I need to use my nest egg for income, and so perhaps capital preservation is the thing that's, first and foremost in your mind when it comes to your assets. What you've done, since you've already established these first two buckets, is everything to the left here is going to be your lifestyle money, the money that you need to survive and just, do things, pay the bills, take a trip here and there, and have enough cushion to be comfortable. Now what you've done is you've bought yourself more time. I'm going to show you a chart here in a minute and show you how that principle works in buying time and what happens with this additional compound interest that we have, with another decade of growth that you're able to experience. If you're able to just take a moment and think back 10 years ago to where your 401k was, to how it has grown, that's the power of compound interest. You can imagine what another 10 years can really do to you there. All right, so how do we use the growth bucket here? Number one, what we always say is it's not that you should have a growth bucket, it's that you need to have a growth bucket. And that's because inflation has been killing us over the past few years. So when we're thinking about, your cost of living increasing over time, oftentimes these two buckets here are fixed, so you may not see increases over time. Out here on the growth bucket though, we believe that the best defense against inflation is going to be the stock market. And the stock market has just been doing great and taking off. And so I believe we are going to see a diminishing of buying power because of this growth that we're seeing in the stock market. Next, I always make a joke saying, rarely do people need an emergency cruise or an emergency vacation. You may be sitting there disagreeing with me, but we also use this bucket for large expected expenses that are coming up, whether it's a new roof, a new car, a big vacation that you're planning. Basically, you're giving us enough time to determine which assets in the growth bucket are best going to be suited for that large expense. Naturally, because we do prefer to have a lot of holdings within these growth accounts with a lot of diversification, there's going to be holdings that have done better than others over time. And so it may be a good time to say, hey, let's take some chips out of those individual stocks or those ETFs and put those towards this big expense that's coming up. Next, and we're going to have a video on this down the road, specifically on Roth conversions. This is where those Roth conversions are going to occur. Because we do like to have a lot of holdings in there, it gives us a whole lot of options to pick and choose which assets do we want to convert into a Roth IRA. Now, sometimes there's holdings that have done really, really well. We're not quite ready to pay taxes on all that when we convert, but maybe there's a holding in there that hasn't performed, but we know that their day is coming. So we may say, hey, let's take that holding, pay taxes on it today, move it into a tax-free account. So when it grows entirely tax-free. And lastly, we know this is important to a lot of you, is the legacy piece of it. Whenever we look at your income plan and show you the cash flow, we know that there is going to be a lot of assets left over. More often than not, this is where that is going to be. And what we want to do for you is figure out what is the best way to do that and the most tax efficient way for that. All right, before I head on to this chart that I want to show you, let's talk specific investments. Now, a lot of you came to us with old 401ks and 403bs that used a lot of mutual funds. Now, mutual funds are a great way to invest throughout your career. They're usually pretty vast. They give you, a lot of market scope, but oftentimes they might have high expense ratios and they're not quite as actively managed as you need now that you're retired or getting close to retirement. Within our growth buckets, we prefer to use individual stocks because it gives us that accessibility and that adaptability where we're able to switch between these market sectors quick. We know that the economy operates in cycles and we're just taking advantage of those cycles. We also like to use ETFs. They usually have lower expense ratios. They follow some indexes that have performed really well over the years. And lastly, there's some really cool strategies that can create additional dividends, that can create downside buffers, and give you protection even within the growth side, so that we're not going completely wild and we're able to pull that risk down a little bit. All right, so now we're going to focus on these two buckets here. We have this chart that does a good job of really kind of outlaying what happens between these two buckets over the course of time within your retirement. So you've retired with $1 million, and what we've done is we've taken 40% of that and we put it into the income bucket, leaving 60% within the growth bucket. Let's assume that you already have your safety bucket established. Okay, now the reason we picked 40% here is just because of a principle we discussed last time, and that's the 4% rule. If we look down the page here, we see that we have a $40,000 withdrawal on an annual basis, which is 4% of that $1 million nest egg that we originally had to start with. So here we're using a 4.5% rate of return, and within the income bucket over the past 10 years or so, whether we're using a fixed index annuity, something like some kind of structured income, dividends, even CDs, a lot of things we're paying much higher than that 4.5%. But for this case here, we want to show you conservative numbers to show you that we don't need to be hitting home runs constantly to have the retirement that you want. And so what we have here is over the years, 13 years down the road, we see that this bucket is entirely depleted. And that is our intention. That is why that bucket is in place, is to know that we're going to be using that for income, and eventually that will be spent down to zero. So in year 13, what we want to do is look across the way here into the growth bucket. Over the past 13 years, we've had $600,000, and here we're just using a 7% rate of return. The S&P has done about 12% over the past 10 years. And we see down here, where's our asset now? Over $1.4 million. And so when we get to that point, all we do, take some assets from here and replenish that income bucket. And we just continue to do that throughout your retirement. Now, we know there's going to be some spending down of the growth just because of those reasons we said. Maybe we're paying some taxes up front, whether it be through Roth conversions or just those large expenses, giving yourself a little bit of a raise each year. But ultimately, we know there's going to be a lot more growth on this side. So this is an extreme simplification of everything, but it really shows how those buckets come into play and how it works all together. So what I encourage you is, if you do have an old 401k, an old 403b out there, it's really hard to separate those assets into these different bucket types and to utilize the growth bucket like you really can. When you move it into a rollover IRA, it opens up an entire world of investing to you. That's what I encourage you to do, just to be able to start exploring some of those options so that you can have the retirement that you want. Thanks, and tune in soon as we discuss Roth conversions.